Welcome to the audio press release, APR, powered by IBN. This original production delivers market and sector insights, as well as executive interviews with innovative executives shaping the future in fast-moving industries, and may feature a client partner of IBN or one of the 75-plus investor-focused brands within IBN's dynamic brand portfolio. As multifaceted financial news and publishing company, IBN leverages its extensive distribution network, utilizing multiple proprietary corporate communication tools to introduce both public and private companies to a vast and diverse audience of investors, consumers, influencers, journalists, and other targeted segments of the public. IBN may have received compensation to produce this audio content. Please be sure to read IBN's entire disclaimers for full disclosures. This article has been disseminated on behalf of Strawberry Fields REIT Inc. and may include a paid advertisement. NetworkNewsWire presents Healthcare REITs, Skilled Nursing Real Estate, Gain Momentum Amid Aging Demographics and Stable Income Growth. Healthcare Real Estate Investment Trusts, or REITs, have emerged as one of the more resilient and structurally supported segments of the real estate market, driven by powerful demographic trends and evolving healthcare delivery needs. As the U.S. population ages and demand for long-term care services accelerates, skilled nursing facilities in particular are gaining renewed attention from investors due to their essential role in post-acute care and the relatively constrained supply environment that limits rapid new development. These dynamics have helped position healthcare REITs among the strongest performing real estate sectors in recent periods, supported by stable demand drivers and long-term occupancy visibility. Within this landscape, Strawberry Fields REIT Inc., New York Stock Exchange ticker symbol STRW, is carving out a focused niche as an owner and lessor of skilled nursing and other healthcare-related properties. A self-administered REIT engaged in the ownership, acquisition, development, and leasing of skilled nursing and certain other healthcare-related properties, Strawberry Fields is focused on pursuing growth through targeted acquisitions, long-term triple-net lease structures, and partnerships with experienced operators to capitalize on the structural tailwinds shaping the skilled nursing real estate market. Strawberry Fields joins an elite group of healthcare REITs, including CareTrust REIT Inc., Sabra Healthcare REIT Inc., Omega Healthcare Investors Inc., and Welltower Inc., that are leading the way forward in this growing space. Disclosure: this does not represent material news, partnerships, or investment advice. A self-managed and self-administered REIT, Strawberry Fields specializes in the acquisition, ownership, and triple-net leasing of skilled nursing facilities and other post-acute healthcare properties. For skilled nursing-focused REITs, lease terms can matter as much as where the buildings are located, because lease structure drives rent visibility. In a limited supply segment, growth often comes from buying existing facilities and leasing them to operating partners under long-term structures. Strawberry Fields Missouri acquisition provides a concrete case study. In an uncertain economy, Strawberry Fields showed its stability by announcing a 16 cents per common share cash dividend for Q4 2025. Healthcare REIT momentum meets tight supply. Healthcare REIT performance in 2025 has been supported by a mix of durable demand and the sector's traditional defensive characteristics. As one example, NAREIT reported healthcare REIT returns of 8.5% as of May 2025, placing the sector among the year's stronger REIT performers at that point. Within healthcare real estate, skilled nursing facilities stand out because supply is not just a construction question. It can also be a permissions and planning question. Many states operate Certificate of Need, or CON, programs that can require approval before certain healthcare facilities, including nursing homes in some states, expand capacity or make major capital moves. In practice, the regulatory friction can slow down new development and expansions, helping keep existing assets relevant when demand rises. Trade coverage in the skilled nursing space has also highlighted how CON frameworks can act as a barrier to new construction and innovation in nursing home development. Quote, existing and new roadblocks to construction and innovation in the nursing home sector are being felt across the country, with the repeal of Certificate of Need top of mind for providers in certain states, as higher tariffs are also expected to impose challenges down the road, stated a Skilled Nursing News report. Between CON laws and tariffs, nursing home operators have their work cut out for them when it comes to new construction, even as closures mount and rising demand amid staffing shortages is likely to exacerbate access issues. End quote. A central Strawberry Fields talking point is simply the scale and focus of the platform. A self-managed and self-administered REIT, the company specializes in the acquisition, ownership, and triple net leasing of skilled nursing facilities and other post-acute healthcare properties. Combining a unique knowledge of the healthcare and real estate industries, Strawberry Fields targets high-quality healthcare operating companies in the skilled nursing and acute care sectors to create a network of carefully selected facilities. Our deep ties with industry leaders allow us to partner with future-focused operators, and our long-standing commitment to post-acute care gives us an advantage underwriting and managing healthcare investment risks, the company states. Our tenants are delivering an exceptional level of satisfaction to the residents and families they serve. Strawberry Fields owns and leases a portfolio of 143 healthcare facilities with an aggregate of 15,600 plus licensed beds. These facilities are spread across 10 states, including Arkansas, Illinois, Indiana, Kentucky, Kansas, Missouri, Ohio, Oklahoma, Tennessee, and Texas. The 143 healthcare facilities comprise 131 skilled nursing facilities, 10 assisted living facilities, and 2 long-term acute care hospitals. That kind of multi-state footprint can help diversify facility-level reimbursement and operating environments while staying connected in post-acute care real estate. Quote, 2025 was the best year Strawberry Fields has had since its inception 10 plus years ago, reported Strawberry Fields CEO and Chair Moishe Gubin in STRW's year-end 2025 report. The FFO growth remains consistently strong, in excess of 13%, and the company's footprint has continued to grow into new states and with new third-party operators. In 2026, the company will continue to look for accretive deals while maintaining its disciplined acquisition approach that has led to these strong results. End quote. Lease structure built for rent durability. For skilled nursing-focused REITs, lease terms can matter as much as where the buildings are located, because lease structure drives rent visibility. Strawberry Fields emphasizes triple net leasing, under which the tenant generally pays property operating costs, such as taxes, insurance, and maintenance, in addition to rent, an approach many REIT investors associate with steadier landlord cash flows when facilities are stable. The company's SEC filings provide specific examples of the types of escalators and lease terms it is using. In an SEC Form 10-Q describing its July 1, 2025 acquisition of 9 Missouri skilled nursing facilities, the filing notes that the facilities added to a master lease were subject to 3% annual rent increases and an initial 10-year term. During 2025, the company completed the acquisition of 17 facilities for $112.1 million. These facilities have average lease expirations of 10 plus years, annual rent increase of 3%, and yield of 11.7%. Acquisition execution in constrained market. In a limited supply segment, growth often comes from buying existing facilities and leasing them to operating partners under long-term structures. Strawberry Fields' Missouri acquisition provides a concrete case study. The company acquired 9 skilled nursing facilities in Missouri for $59 million and leased 8 facilities to the Tide Group under an existing master lease, with a 9th added to a separate master lease structure. The announcement quantifies the rent impact on operator relationships, noting that the Tide Group portion increased annual rents by $5.5 million, subject to 3% annual rent increases, while the 9th facility increased another operator's annual rent by $0.6 million, also subject to 3% annual increases. That kind of disclosure helps an article connect acquisitions to forward rent potential, rather than treating transactions as just headline growth. At Strawberry Fields, these acquisitions and scale are part of a broader accretion narrative. The company's investor presentation notes peer comparison focused on return and payout metrics and positions the portfolio as paired with accretion, which can be a useful bridge to explain how management thinks about adding properties while maintaining divided capacity. The presentation also observes that Strawberry Fields is the closest pure-play S&F real estate investor in the market and boasts the lowest payout ratio among its peers. Income profile, funding approach. Dividend stability and coverage are often a core investor interest for REIT stories, especially when rates and credit conditions are moving. In an uncertain economy, Strawberry Fields showed its stability by announcing 16-cent per common share cash dividend for Q4 2025. That announcement followed the company's year-end 2025 investor presentation, which highlighted STRW's dividend yield and emphasized a low payout ratio relative to peers. This is often where interested observers connect the steady rent plus escalators plus acquisitions story to what investors usually care about, whether the dividend looks supported by cash flow. On the balance sheet side, STRW's presentation discusses mix of debt, noting that a majority of the company's debt is fixed rate and includes long-term HUD-guaranteed debt with long maturities and a stated weighted average interest rate. In today's environment, emphasizing duration and fixed-rate exposure is one way to frame how a healthcare REIT seeks to reduce refinancing pressure while continuing to pursue acquisitions. Each of these components alone is remarkable in itself. However, taken together, Strawberry Fields' platform, lease structure, acquisition approach, and stability paint a picture of a healthcare REIT that is not just showing impressive performance today, but has potential for even more growth and success moving forward. Quote, over the next 2 decades, the above 70 segment will become the nation's dominant age group, the company states. By 2030, there will be 72 million older persons, more than twice the number in 2000. Strawberry Fields is taking a leadership position by assembling a significant network of skilled nursing facilities in America's heartland, a collection of the best-managed properties of their kind, each equipped to serve their community now and in the future. End quote. The audio press release, APR, is an original content production powered by IBN, a multifaceted financial news and publishing company that delivers next-generation corporate communication solutions. Utilizing proprietary corporate communication tools such as news aggregation and syndication, social communication, and brand awareness techniques, among others, IBN introduces both public and private companies to diverse audiences to enhance reach and recognition. IBN may receive compensation for services and solutions provided to its client partners. The owners, officers, and directors of IBN or financial analysts mentioned in this production do not hold any position in and do not intend to trade the securities in their own accounts. This production is not an offer or recommendation to buy or sell any securities that may be mentioned in this production. The information in this broadcast is presented solely for informative purposes and is not intended to be or should it be construed as investment advice. As in all investments, investment in the featured companies carries inherent investment risk. Listeners should review the company thoroughly with a registered investment advisor or registered stockbroker. This production by IBN is not purported to be a complete study of the featured company or other companies mentioned. Information used and statements of fact have been obtained from featured companies and other sources, but not verified nor guaranteed by IBN as to completeness and accuracy. Such information is subject to change without notice. Please read IBN's entire disclaimers and disclosures at www.ibn.fm/disclaimer. Thank you again for listening to the audio press release APR powered by IBN.